All right, guys, chapter 13. This one is going to be quick because it is mostly ratio analysis and kind of going over what we've already talked about in other chapters. It's not a lot of financial state preparation. It's mostly looking at prepared financial statements and putting them into these ratios. Um, so most of these are we're going to do for depending upon if we're using them for our managers. Some ratios are good for management, some are good for external, for shareholders. Lenders are going to look at some of these. Um, Inventory turnover, some of our current ratios, current analysis, quick ratio is good for our managers to decide if we're going to actually have cash available to pay our bills relatively quickly. There is one slide here that I've told classes before to make sure you either print this out or have it readily available for your exam because it summarizes all of the ratios in one place. I believe it's slide 46. Um, the issue in this chapter, the really the only issue in this chapter is if you don't know what current assets are now, or if you don't know what current liabilities are, then I wish I could help you more. Because if you don't know that, almost 2 years into accounting, then we have all failed you somewhere. But that's really all these formulas say is they're going to tell you what quick current assets minus current liabilities. But if you don't know what current assets are, the formulas aren't going to help you. So I think we're all in pretty good shape with that. Obviously, if you're not, some please email me, call me, do something. We need to kind of go back and refresh what those are. All right. All right. So most of these are going to put these into these categories about liquidity, efficiency, solvency, profitability, market prospects. That way we can look and see what we're going to do with these. Solvency is kind of a new word. We've looked at some of these other ones already before. Solvency is when you're looking at your balance sheet. If you have, the accounting equation, assets equals liabilities plus equity. Solvency would be a situation where if you had assets and liabilities and you were to end up with actually a negative retained earnings, where your liabilities are greater than your assets. That's what we've always talked about. What your equity in the business is, or if I was to sell off all my assets and pay off everybody that I owe, I would have something left over. That's the owner's claim on the company. If that number is negative, we are insolvent. We don't have enough assets to pay our bills. So that's what solvency means. We would call that insolvent. The company is insolvent at that point. All right. We're going to use all of these things, information off of all these items to populate our ratios. Anything from the income statement, balance sheet, statement of stockholders' equity, the statement of cash flows and notes, all that is fair game. When we compare our ratios, we can do it inside our own company. We can use it for prior results. We can say what we've done in prior years or for future years. We can base it on competitor. We can use it for the industry we're in and standard guidelines we have. Competitor is kind of tough if we're a private company because how do I get information? Again, I talk about things that I know. If I'm, as a small business, as the pharmacy that we've owned, how do I get information about another small pharmacy? I can get information about Walgreens, but is that really comparable? They have different information. They have different economies of scale because they've got 5,000 stores. I have one store. So is that really a competitor to me? They're not. They are, but they're really not. All right. So it's hard to get that. In the builder world, you can actually join something called a builder 10 or a builder 20 group, and they will put, you pay this accountant somewhere in another state most of the time to compile data of, home builders that build less than 50 houses, and it'll all be anonymous, and they can say that, all right, based on your sales, you should be running 25% profit margin. You should have this many employees. You should have this much rent. And all that information is compiled by them, but it's kept anonymous. That way you don't have to worry about somebody going in and saying, where Jeremy's buildings are really good in a profitable area, I need to go in and start building houses there. They don't know where I am. They don't know where my information is. And then you're able to talk to those people anonymously and get information about what they're doing. Um, so that's kind of what we can do too. As an industry, we can try that. I can try to say, well, I should know that I should be at 20% gross profit margin. That's what the industry standard is. And I can use that if I have it. And then I could say, well, that's what Walgreens has. That's what their standard is. I can shoot for that and maybe never attain it. All right. Horizontal analysis, we are going to look at 1 year. Back up. Horizontal analysis, we're going to look at several years with the oldest first. That's what we did in the BP oil spill analysis that we had to do. We could calculate if we were going to have any money that's due from the BP oil spill. We would start with the oldest year and we would use that as our benchmark. That's the 100% ratio. And then anything forward is what we would actually go through and say, okay, from 2019 is if I have 5,000 in cash, that's 100%. The next year, if I have 6,000 in cash, what percentage applied toward the 5,000 do I have cash this year? It's 110%, 120%, whatever the ratio is. And I would go horizontally and I would start with the oldest first. Vertical is what we do most of the time in our income statement. I'm going to say that what I'm going to compare on my income statement is what percentage of my rent, what percentage of sales is my rent? I want my rent to be 5% of sales. I want gross profit margin to be 25% of sales. I want my net income to be 15% of sales. And I'm using that as my benchmark. All right. All right. So we use our base period here, the dollar change amount. So this is what this will look like on a comparative balance sheet. I know that's small, but y'all can pause it and zoom in or whatever you need to do. We're going to use this prior year as our benchmark. So the dollar change is a change from 1 year to the next, and that's the percentage change. And we're doing this for all of our accounts, from the oldest year to the newest. What changed? What percentage did it change? That's the horizontal analysis. This might be run out for 5, 6 years. It doesn't have to just be 2 years. Same thing for comparative income statements this way. We're going to do it based off the prior year. All right. Trend analysis, this is when we're going to do multiple years and say over a several year period, do we see a trend? Are we going up? Are we stable? Do we have some fluctuation where 1 year goes up, 1 goes down? What happened in that year? Do we have something that was an outlier? Can I see that we have steady growth over several years or not? Is it just, do we know why? Vertical analysis. That's your base amount. Is usually in balance sheet. It's going to be our total assets or total liabilities. We're going to say what percentage of cash, what percentage of total assets is total assets. All right. All right. So you can see here we're using total assets and say cash is 14% of our total assets, which is what I'm trying to find here. Is there what percentage of my total assets is my accounts receivable? All right. For the income statement here, we're looking at what percentage of each one of my other income statement items, what percentage of sales are those items? Net income is 21% of my sales. Cost of sales is 62%. Gross margin is 37%. All right. These are the ratios for liquidity and efficiency. We've talked about all these before, whether it's in 241 or 242. We've never had a test on them because we're trying to build the information to be able to use these ratios. All right. Working capital we've talked about before. All right. This one is the same information. It's just current assets over current liabilities instead. Our asset test has short-term investment. We're looking at things that I can generate cash with very quickly. Cash, short-term investment, current receivable. It leaves out prepaids. It leaves out inventory. They are current assets because it's under a year. But I want to know stuff that I can get cash with maybe in the next maybe 3 or 4 weeks because I don't have to pay my bills with them. Receivable turnover. All right. We're going to have all of this information. We can average 2 years together for average accounts receivable. All right. Average inventory the same way. We're going to average all this together. All right. Day sales. All this stuff is going to be given to you. Debt ratio equity times interest earned. Profit margin we've already calculated. Sometimes it'll be on your income statement. We just said we net sales minus cost of goods sold over net sales. It's already there. Profit margin was already there. Net sales divided by over net income. All right. Again, we have average total assets because we have two on our balance sheet. We have both of them. We can actually divide and average here. Dividend yield, they will give you, they're going to actually give you these two pieces of information, uh, cash dividends per share and the market price per share. Here's the slide. This is the one that I would print out for your exam or have it readily available. It has all of this information summarized for you, and we can kind of go from there. Okay. What else we have on here? All right, discontinued segments. All right, what I mentioned before about this. This is something we want to show that is probably an outlier. This one shows it as a gain. Most of the time, they're going to show this as a loss. This is why we're going to do it this way. Is we want to show that our operations are profitable by themselves. Same reason we've done this before. Why we have a classified and multi-step income statement is I want to show my operations just by themselves. Okay, this is used to predict future operations and show any kind of outlying gains and losses that are probably a one-time item, things that don't happen very often, that are I don't want to muddy the water of my operations, and I want any of my outside users to say that look, this is something that maybe was bad this year. I had a segment, a part of my business that was not doing well, but I sold it and I took the loss this year. The example I've given before is even with Under Armour, that their shoes don't always do well, but their clothing usually does well. So if they decided to just say, I'm done with shoes and sold all their equipment, so all the marketing information, all the marketing team that they have, um, all the manufacturing equipment for shoe, whatever they have to have, and they took that loss this year, they could show, but look how much money we're making on our clothes. Okay, this is what we're actually doing. This is our core business model now. We're just going to stick with just clothes. Okay, and then they would be able to say, guess what? We're not going to have to worry about shoes anymore. We're going to do okay. That's a one-time hit we had to take. Yes, we have an actual loss this year, but going forward, we're going to be just fine. So we want to separate it out for that reason. All right. All right. Let's see what else we have here. All right. So that's 13, guys. 13 is this is not a big drawn out thing. So um, I've got a homework video there for you guys as well. So if you have any questions, like always, email me. Thanks.